Hey everyone. I'll do a market review today because I want to explain my thought process and the position I'm taking, which is bullish. Like I keep posting this stuff that is way too bullish considering what is happening. Let's look at it. So switch to hourly. This is kind of it. Now, my position is actually super bearish, but over the longer run. Like I keep telling you guys, I think we are already in a bear market. We just haven't realized that yet at the index level, but we will. Furthermore, regardless if Trump backs down now and what happens, whatever the escalation happens, it's irrelevant. The damage has already been done and the damage is gonna stay here. It's not going away. Even if the US withdraws, there's still gonna be tension in the Middle East between the countries because they bombed each other, and things are not going back to normal. Furthermore, the second and third order effects are gonna start hitting later on, like probably end of March, beginning of April, and then we get the inflationary impact, which is also going to be visible in the data for the next CPI print. Basically, we had CPI yesterday and it was fine, basically in line. But this is it, inflation year over year. But this was the cycle low. So starting from this point on, we will be going up, even if, again, even if the war ends, which maybe it does, maybe it doesn't. Most likely it won't, or it's gonna be just a short-term de-escalation, and basically the taco gets priced into the markets and the markets react and whatnot. Even if that were to happen, we are already going to be hit with inflation, and it's either going to be a single hit or a double hit. How I'm thinking of things, maybe we were at 2.4 yesterday. Uh, was it 2.4? I think 2.4. Let me check. Recent yesterday. So CPI yesterday came in at 2.4, yeah. So at 2.4, the way I'm thinking, again, even with full de-escalation, the damage has already been done. It will take time for capacity to be brought back online. There are already some mines in the strait. Maybe they will clean them up fast, but regardless of that, the damage is already done. And I think we will see like 3.3, 3.5 CPI for June. This means in July. So the June data comes in July. So the July print that we get in July, which is actually the June CPI data, is going to be like 3.3, 3.5. If, and this is the best case scenario, this is the de-escalation. It's a somewhat small spike in CPI, and we peak in June, and then we start going down. If this doesn't stop, and I think this is the default case, some form of conflict will still persist even if the US backs down, but the US will probably not back down, or they will temporarily, but then go back in. Like Trump can say full taco, peace for 2 to 3 weeks, and then he goes back in. This is what I'm thinking. If that is going to be the case, I think we see 4.5 to 5 by September. So we have leg one that will peak in June just from what we have so far. And leg two, if we have continuation, it will peak in September, uh, probably like for the October September print. It's going to be like 4.55, depends on a lot of other things. Now, this I think will lead to a major leg down in the April to June window, most likely beginning in April, and it will be a multi-leg down. That will probably be 20%. 20% versus the top, not here. Maybe let's consider the top here. 20% is a long way down, like here, 5,500. This can become more and probably give us like 280R, 5,200, something like this. It won't quite reach the lows of the April tariff tantrum. So either here or here would be my best guess. Uh, comparing the ATR levels of this year with the previous year, this was equivalent to a move like this. So it was also a 1.1 ATR golden fib move, this one. So this is the type of move I think we will be getting. But short term, I still think we are bullish, and my base case remain this. I'm not sure about that move above 700, but I'm pretty sure about the move back to 700 because of we are way too panicked for the level of thing that is happening right now, and too under panic for what is coming in the future. This is kind of how the market works right now. So we see every day that SPY moves what? Aside, let's just look at the daily moves, and I'll turn off the ribbon. So we had a couple. 1.57. This was a very large one. Then we have point 0.05, point 0.10, point 0.56, minus 28, point 28, plus 0.69, minus 1, plus 0.77, and so on and so on. Even the large ones, which was this one, minus 133, and so on. So VIX is the implied volatility of SPX in a way, and we are based on how the realized volatility has been, meaning the SPX real moves. VIX is way above the realized volatility, and this will automatically create a mean reversion to uh, get closer to realized volatility, which I posted yesterday and said that we should be like at VIX 1012. Like we should be around here, maybe not 1012, but something like this between 14, 15 would be more reasonable. Maybe even something like this with the way SPX has moved. Like we have no, with the way SPX has moved, with the realized volatility, we have no reason to be at VIX 25 or even higher. 30 was here. Furthermore, this type of move, like we have rejection here, rejection here, rejection here, doesn't cause a bounce. Like it doesn't. It's there has to be a larger fade, and then we get a bounce. Like for example, the way it happened here. But whenever we get a big fade like this, we generally go lower and we go back above 20 almost always to like this 15, 16 area. This is kind of the baseline of how it behaves. And we haven't done that. And even today, like we had shifts blowing up, we have other stuff, and nothing is really happening. And this is true for oil as well. Like this is oil. We had this huge move, which oil behaves like VIX. Once we get a big rejection, we generally don't see further escalation immediately, maybe later on, but we should be fading even lower, maybe back to 70 or something. Probably no, that's way too low, but more like 80 should be the next the baseline right now, not 90. And this is just how it is. Like things are not behaving in a scary way, even though scary things are happening. But on the market side, things are not behaving in a scary way at all. And what will happen on a daily basis is because the theoretical volatility, which is VIX, is way too high, and the realized volatility, which is SPX, is basically low, there is a daily VIX unwind. And this is why we're seeing these bottom week candles all the time. Like VIX is way too high for the level of realized volatility. What we need to change this environment is either a huge daily SPX move like minus 3%, like I keep mentioning that big initiation day that could have happened at some point here. This day could have been it if we didn't reverse. Like instead of being green and reverse, this closed here, and then continuation down. VIX would have gone to like 60 or something. All of this 44. Instead of fading, this would have been to 42, and then another big day, and that would have been it. We goes like uh, where were we? We went to 662. We would have gone to 650, maybe a bit lower, like 645, something like this. And then we find the bottom and we go higher. Potentially, maybe we just bounce, then we do another leg down. I think I explained scenarios in the previous video when we were close to this candle. We didn't know if it would bounce or not. So this being said, we are getting close to the expiration. So we have expiration next Wednesday on the 18th. I expect we will get a mean reversion on VIX that will provide support for the market. I also said yesterday that if somehow VIX drops but SPX is still here, that is going to be concerning because we could have a situation where VIX drops 10%, let's say, but the market doesn't really move higher significantly. Instead of, I drew the various scenarios, and let's say we get that big fade in VIX. By the way, this is versus current levels. That fade just to get to like 15 is 40%. So to get to 15, this is 15.03, so 49.85%. So we have the potential for 40% fade in VIX. And what I was going to say is that if by some strange circumstance or behavior we get to something like this level, this is the baseline level 686, or basically the yearly AVWAP, the mean reversion for the market. If by some strange mechanics behavior we get to this level with the full 40% fade in VIX, then it becomes really, really concerning because when we start moving down again, it will have a lot of momentum and there's a lot of room for VIX to expand as we go down. But I don't think this is feasible. My expectation is that we will get at a minimum to 700, depending on what else happens, various headlines and whatnot. And this is a fresh headline of regional countries trying to talk down Iran and trying to find some form of communication with them to get the escalation. And I imagine the market would like this kind of headline. So if we keep getting this type of headlines, and most likely we will, and potentially that temporary back down that we should be expecting from the US happens, there is a lot of room to go higher, and we would get this move up, we would get this other move up, which would be something like 20 to 40% in VIX, and the last 20% could be this. And if all these things happen, like I explained, then when we get to FOMC next week, we would basically be in the single spike CPI scenario, in which, yes, there will be a spike because of all the damage that already happened, but it will be a single spike. So that 3.3, 3.5 June print would be the baseline, and the Fed would know that. And because they know that, they will treat it as a one-time event, not a persistent thing. So it's transitory CPI spike. Just like tariffs were, it's a single shock, and then things will get back to normal. And because that will be the baseline for the FOMC, they will be biased towards language and behavior to support the economy. On top of the current blow up with the Middle East, we have a weakening economy. We have bad jobs data. So if they believe that this event is transitory and a one-time shock, they will be more concerned about weak economic data, weak jobs data, and potential for a slowdown than they will be with inflation. And they will send that message. So basically, for FOMC, maybe we are here. So for FOMC, we are like 680, 690. Let's say we are at 690. And the Fed gives that message that they will still be cutting. They're still considering cuts. There's blah, 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 blah. So the appeasing message and the anti-recession message instead of the anti-inflation message, which we should be getting because of energy spike, then we enable the second leg up to 700 and potentially even higher. Because as I said, when we get a quarterly impulse uh, uh, around, basically the rule is like if the move starts for OPEX week, if a directional move starts in this week, it tends to persist until the end of the month. So if we get a bullish directional move beginning here, which will be enabled by some potential positive headlines, VIX expiration, which would make VIX do a mean reversion, and the FOMC dovish language. It should persist until end of month. And this is why it's drawn this way. So basically, we begin here. You see that even today, we are fading the move down. And again, we are way, even if it were, so this is US 500, so minus zero point 0.2. Still way under 25 VIX. This is like a 12 VIX move. It shouldn't happen. So we're fading it. We're gonna go higher. Some more positive headlines. The Fed ignores the inflation part. It's also dovish, and then we go higher, and we go higher because of the mechanics of the market and the way it should behave around OPEX week, and the fact that we're oversold and blah blah blah, everything in between. But once we get to this point, either this point here, which will be another way to express the move tends to continue until end of month, is that we won't reverse until end of month. So there's two scenarios here. One is we go to 700, then go sideways and then drop, or we actually do have bullish continuation and we go even higher to like 710 and then we drop. So this is how I see it. So even if we top at 700 and then we just go sideways, we won't begin the drop until we cross over into April, in my opinion. So this is the whole reasoning. But once all of this happens, then I I see re-escalation beyond this point. I see second order effects starting to getting hit. I'm 100% convinced that there will be significant investment reductions from GCC countries in the US and in the AI build out. And at this point, again, there is enough damage done that there will be impacts on everything, including the AI build out, including on the market. And those things will bring us a 20% correction, up to 25% during the April June window. And my expectation is that we will bottom out in June. So this will be like the bear market. We bottom out in June. It doesn't mean we do not go lower, but we should have a significant bear market rally in June. Depending on the velocity of it, if it could be even faster. I'm not gonna draw it out right now. We'll talk about it at some point in the future once things start realizing. But for now, uh, we go up until end of the month. Then that's a cycle top, and we start going down and don't look back until June, in my opinion. And it will be a multi-leg down. So even in that drop, assuming it starts April 1st, let's say, and it goes until June, there should be at a minimum two bear market rallies that will be like 5-10% during that interval. So there will be lots of opportunities play to do short-term plays and that are very profitable. We will see when those become reality, but until then, this is my logic. So it's all based on a VIX mean reversion, some de-escalation talk, a dovish Fed because of the de-escalation, and all of this should allow a move up to 710. But after that, the de-escalation fails and second order effects kick in, and we finally begin, because we will also be unpinned because we are past OPEX. We begin going down and we don't look back beyond that. But all of this is also, take it with a grain of salt. I will reevaluate things when we get to this area and see if it's still true, if maybe there is too much momentum and we can continue going higher than that as well. We'll see when we get there. But for now, this is why I believe that the bullish case is still the default one for the very short-term future of the next 2 to 3 weeks. But after that, all bets are off. But we'll see when we get there. Okay, have a good one. Bye bye.